T has a term policy that allows him to continue the coverage after expiration of the initial policy period. What type of term coverage is this? It's renewable. An architecture firm would stand to lose a lot of money in the event of the death of its project manager. Which type of policy should the firm purchase on its project manager? Key person life policy. Which statement about the whole life policy is true? Cash value may be borrowed against it. How does a typical variable life policy investment account grow? Through mutual funds, stocks, bonds. Stranger-owned life insurance is when a person purchases life insurance only to sell in third party with no insurable interest. Who benefits in investor-originated life insurance, IOLI, when the insured dies? The policy owner. Term insurance has which of the following characteristics? It expires at the end of the policy period. Which of these is not relevant to when determining the amount of personal life insurance needed? Local unemployment rate. Which of the following life insurance policies combine term insurance with an investment element? Universal life. How long does the coverage normally remain on a limited pay life policy? Age 100. Which of the following life insurance policies combine term insurance with an investment element? Universal life. Jay is 35 years old and looking to purchase a whole life insurance policy. Which of the following types of policies will provide the most rapid growth of cash value? A 20-pay life. C is a key employee at ABC Incorporated. If a key employee life policy is purchased on her life, which of these statements would be true? ABC is the policy owner, C is the insured, and ABC is the beneficiary. The cash value in a universal life policy may fluctuate to reflect changing assumptions regarding mortality costs, interest, and expense factors. The cash value in a universal life policy may fluctuate to reflect changing assumptions regarding mortality costs, interest, and expense factors. Kay is shopping for a permanent life insurance policy that will offer her the most protection per dollar of annual premium. Which of these policies best fits her needs? Straight life. Which of these types of policies may not have the automatic premium loan provision attached to it? Okay. Which of these types of policies may not have the automatic premium loan provision attached to it? Decreasing term. Who has the option to renew a renewable term policy? The insured. Company Z has a cross-purchase buy-sell agreement in place among its 3 founding partners. If the agreement is funded with individual life insurance, what would it require? Each partner must own a policy on their other partners. Kay purchased the life insurance policy in 1986, which paid 10% interest in the early years of the policy. 20 years after the purchase, she received a notice from the insurer stating that the policy will soon terminate unless a much higher premium is paid because of falling interest rates. The type of policy is known as a universal life policy. Kay at age 45 and his wife, age 43, have 3 children. They purchased a family policy that covers Kay's wife to age 65. All these situations will pay death benefit except Kay's wife dies at age 66. Life insurance, the need approach is used mostly to establish how much life insurance the client should apply for. The combination of whole life and decreasing term insurance is referred to as family income policy. The combination of whole life and income policy term insurance is referred to as family income policy. Life insurance immediately creates an estate upon the death of an insured. Which of the following policies is characterized by the guaranteed minimum death benefit? Life. Variable life. Life insurance immediately creates an estate upon the death of an insured. Which of the following policies is characterized by a guaranteed minimum death benefit? Variable life. A 15-year mortgage is best protected by what kind of policy? 15-year decreasing term. The most important factor to consider when determining whether to convert term insurance at the insurer's attained age or the insurer's original age is the cost. The most important factor to consider when determining whether to convert term insurance at the insured's attained age or the insured's original age is the cost. P is looking to purchase life insurance policy that will pay a stated monthly income to his beneficiaries for 20 years after he dies in a lump sum of $20,000 at the end of that 20-year period. What type of policy should P purchase? Family maintenance policy. Y purchased $100,000 worth of permanent protection on himself and $50,000 worth of 10-year term coverage for his wife on the same policy. Which of these policies did Y purchase? Whole life policy with an other insured rider. Three law partners form a cross-purchase buy and sell agreement. The agreement is funded with individual life insurance. How many total life policies are needed for this agreement? 6. A life policy that contains a monthly mortality charge as well as self-directed investment choices is called an variable universal life policy. S, at age 40, is looking to buy a life insurance policy that will allow for increasing or decreasing in the coverage as his needs change. The policy best suited for S would be universal life. A company that owns a life insurance policy on one of its key employees may do all of the following except change the policy's interest rate. Which of these is not considered to be cost connected with an individual's death? Business expenses. Under a graded premium whole life policy, the premium increases each year during the early years of the contract and remains the same after that time. Under a graded premium whole life policy, the premium increases each year during the early years of the contract and remains the same after that time. A life policy with the death benefit and cash value can fluctuate according to performance of its underlying investment portfolio, as referred to as variable life. What does a face amount plus cash value policy pay upon the insurer's death? Face value amount plus the policy's cash value. A policy that becomes a modified endowment contract, MEC, will lose money. A policy that becomes a modified endowment contract will lose many of its tax advantages. T would like to be insured $10,000 is available. T would like to be assured $10,000 is available in 10 years to replace a roof on his house. What kind of $10,000 policy should T purchase? 10-year endowment.